June 27, 2012. London. Regulators level a $450 million penalty against Barclays Bank. The fine exposed a chilling systemic truth. The baseline math of the global economy was completely artificial. Every single day, the financial world relied on a single percentage benchmark called Libor. This number dictated the borrowing costs for over $300 trillion in financial contracts across the planet, directly influencing everything from multi-billion-dollar corporate bonds to regular home mortgages. It was designed to be the objective anchor of global capital. Instead, it was an illusion. The calculation process was deceptively fragile. Every morning, a panel of the world's largest megabanks submitted estimates of the interest rates they expected to pay to borrow funds from one another. The regulators took these numbers, calculated the average, and published the daily rate to the world. The system operated entirely on an honor code. There was no independent verification of the numbers. A small network of traders realized that a fractional movement in the daily published Libor rate meant millions of dollars in instant profit for their specific trading bets. They stopped submitting honest estimates. They turned the foundational interest rate of the global economy into a coordinated private negotiation. The mechanic of the fraud was transactional and direct. Traders at major institutions like Barclays, UBS, and Royal Bank of Scotland routinely messaged their internal rate submitters, dictating what the daily numbers should look like. Official investigation documents later exposed the complete indifference of the participants. In one archived log, a trader explicitly asked a submitter to lower the rate, writing, "If you do that, you have no idea how much money you will make me." The submitter replied, "Done. Check it out tomorrow." The trader responded, "I owe you a bottle of Bollinger champagne." The baseline math of the financial world had decoupled entirely from market reality. It was being bartered for luxury wine. During the 2008 crash, the manipulation took on a more dangerous structural purpose. As megabanks faced imminent collapse, high Libor submissions signaled to the market that a bank was desperate and risky. To project a false image of financial health, senior bank executives directed their staff to artificially lowball their submissions. They intentionally lied to regulators to hide their liquidity crisis, keeping the global market blind to the true scale of the systemic failure. The illusion shattered when international regulatory agencies launched a coordinated probe into internal banking networks. They uncovered thousands of archived instant messages showing that the fraud was not the work of a few rogue employees. It was an institutional culture. The exposure triggered a massive global realignment. Over the next 5 years, international authorities levied more than $9 billion in total fines against the world's largest financial entities, including Deutsche Bank and Citigroup. Chief executives were forced to resign under intense public scrutiny. A small number of individual traders faced criminal prosecution and federal prison sentences. The damage to ordinary citizens was vast, but largely invisible. Because Libor artificially altered interest rates, millions of retail borrowers unknowingly paid inflated rates on their loans, while public pension funds lost billions in returns on their investments. The institutional response was absolute. Financial authorities declared the benchmark fundamentally compromised and structurally unfixable. A permanent global transition began to completely phase out the rate, replacing it with transparent, transaction-based benchmarks like the secured overnight financing rate. The manual honor code system was completely dismantled. The Libor scandal demonstrated that the most devastating financial crimes do not require complex shell companies or late-night escapes across borders. It proved that if you control the baseline math, you can quietly siphon billions from the public, relying entirely on the blind trust of a system that assumes the numbers on the screen are real.